The AI boom, insights, and potential risks. The release of OpenAI's ChatGPT in November 2022 marked a pivotal moment in artificial intelligence history, particularly for generative AI. In 2023, funding in the generative AI sector surged dramatically, with major players like OpenAI and Anthropic securing substantial capital. According to CB Insights, generative AI firms raised an impressive $25.2 billion in 2023, an almost eightfold increase from the previous year, making up over a quarter of all AI-related private investments. But it wasn't just startups that were enthusiastic about AI. Investment and implementation of AI technologies became a cornerstone of corporate strategy. By the end of 2023, AI was mentioned more than 30,000 times in earnings calls, based on data from FactSet. Companies in the S&P 500 that referenced AI in their earnings reports saw an average stock price increase of 28.6%. While this correlation does not imply causation, it highlights that more companies view AI as a significant growth driver. With all this excitement and investment, we must ask, is this enthusiasm grounded in solid fundamentals, or are we witnessing an AI bubble? If so, when might it burst? Understanding financial bubbles. Financial bubbles are a recurring phenomenon characterized by a rapid rise in asset prices followed by a sharp decline. They are often fueled by exuberant market behavior, speculation, and irrational decision-making, leading to prices that far exceed the asset's intrinsic value. Technological advancements frequently lead to financial bubbles due to their potential to revolutionize industries and disrupt existing business models, which generates excitement and optimism among investors. This can result in speculative investments based on incomplete or overly optimistic information. In the early stages of new technological developments, there is often a lack of comprehensive understanding among the general public and even investors. This information asymmetry can lead to misguided investments. Media coverage and hype further amplify speculation, creating a buzz that draws in a broad range of investors, including those with limited knowledge of the technology. The fear of missing out FOMO drives many to jump into the market, boosting prices as more people invest based on others' actions rather than solid analysis. The dotcom bubble, a case study. Consider the dotcom bubble of the early 2000s. The internet was poised to transform businesses and daily life, leading to a flood of investments in internet-based companies. Companies with .com in their name saw their stock prices soar, regardless of their actual financial health or business model. Investors poured money into these companies out of fear of missing the next big thing and the hope of massive future profits. However, many of these companies lacked sustainable business models and realistic revenue projections. The initial excitement and rapid increases were driven by speculation rather than solid fundamentals. When it became clear that many of these companies couldn't deliver on their promises, the bubble burst. Stock prices plummeted and many companies went bankrupt, causing significant losses for investors. Stages of a financial bubble. Financial bubbles typically progress through 5 stages. Displacement. A change in economic circumstances, such as technological innovation or regulatory shifts, creates new opportunities and attracts investor interest. Boom. Prices start to rise as more investors enter the market, driven by optimism and expectations of future gains. 3. Euphoria. At the bubble's peak, prices soar to unsustainable levels. Speculation becomes rampant, and asset prices are driven purely by the expectation of selling at higher prices rather than intrinsic value. Profit-taking. Some investors recognize the unsustainable nature of the price increases and start selling their holdings to take profits. This stage often goes unnoticed initially. Panic. The market realizes that prices are unsustainable leading to a sharp decline as everyone rushes to sell, causing prices to collapse. Are we in an AI bubble? If we are in an AI bubble, we might be at the third stage, Euphoria. Euphoria explains why new startups like Inflection AI, Stability AI, and Cohere are valued at over $1 billion despite generating minimal revenue. It also explains why companies mentioning AI see their stock prices rise. The combined market value of Alphabet, Amazon, and Microsoft increased by $3 trillion during the AI boom, with these companies expected to generate $20 billion in additional AI revenue in 2024, according to analysts' projections. The market is currently valuing AI at a revenue multiplier of 150. Before this AI frenzy, Microsoft was valued at about 10 times its revenue, Alphabet at 5 times, and Amazon at 4 times. A 150 multiplier strongly suggests that AI's economic promise might be overvalued. However, it's not that simple. These figures alone don't paint the full picture. We can't fully attribute the increase in market value to AI hype. Other factors likely contributed to the growth of these companies. Plus, when the market invests in something, it doesn't always expect immediate returns. Investors often look for long-term potential. What seems overvalued today might be justifiable in a few years. The potential of AI. McKinsey estimates that generative AI could boost worker productivity by up to 70%, with half of all work becoming automated sometime before 2060. This automation and productivity could create up to $4.4 trillion in new economic value. For context, the global economy was roughly $140 trillion last year. So, generative AI could add about 4% to the world's economy, which is a significant boost. There's a lot of potential revenue to be generated by generative AI. The risk of a bubble burst. But this is exactly what makes a bubble almost inevitable. In every financial bubble, the underlying technology's economic promise felt real and often obvious. Think back to the dotcom bubble. People knew the internet would have a huge economic impact, justifying high valuations and unsustainable growth until it all collapsed. What might trigger the AI bubble burst? If we're in an AI bubble, what might trigger its collapse? Usually, it takes one significant event to start the decline. During the dot-com bubble, news that Japan had re-entered a recession triggered a global sell-off that hit tech stocks hard, leading to the bubble's burst. In the 2008 housing bubble, the collapse of New Century Financial is often seen as the trigger. For AI, the trigger could be anything from declining demand for chips to the collapse of a major AI player. The future of AI. Even if we are in an AI bubble, it doesn't mean the entire AI industry is doomed. Sure, stock prices might collapse, but history shows that valuable companies can weather the storm and come out stronger. Look at the dot-com bubble. Overhyped companies without viable business models, like Pets.com, went under. But more fundamentally sound companies like Amazon, despite losing over 90% of its market cap, survived and thrived because of its solid foundation. The same will likely happen in the AI space. When and if the AI market sees a huge decline, many companies and startups will fail. However, those with strong fundamentals will endure and continue to grow in the future.